Hello, everyone. Welcome to our weekly update this week. We have Wayne with me this time. And as I have a lot of questions, why don't we jump right into it and ask Wayne? So Wayne, this week we have seen the market has continued to edge up despite record COVID cases numbers in many parts of the US. So the market seems to have shrugged off a lot of these numbers. At what point do you think these numbers will become a factor and take a hit on the market?
Well, there's three things that I look at really, and COVID is just one of them. And three things the market's looking at here. There's COVID, there's the breakthrough in medical, and then there's what's happening in the actual economy, concurrently. And with the COVID this week, the Sun Belt, there's definitely an issue there's a breakout there. And the good news there is that the mortality rate's lower than anticipated. So they're keeping the deaths in the U.S. below 1,000, which is better, not great, but it's a semi-positive. But during the course of the week, there was good news in the medical front. Some therapies came out, and Moderna and J&J had good announcements regarding their vaccine therapies. So that was a good news there. And in the economic side, the housing sector seems to be humming along. People are staying at home. They're doing improvements. They want to move to bigger homes. There's more housing starts. And retail sales have actually gone back to where they were pre-COVID, which is amazing when you think about it. But people are still consuming. There's not going to bars or going on trips and going to movies and hotels. So the consumer is still spending. And thank God for the government money that's being injected into the economy, which is helping keeping things afloat, and Federal Reserve, of course. So it's keeping retail sales afloat. And so I think the economic numbers and the good news in the medical side help offset the COVID outbreak in the Sun Belt.
Thank you. And so apart from the gains that we've seen in the market this week, we have also seen a notable rotation from the growth sectors to value sectors. What is really driving that rotation?
Well, the growth sectors have been doing well because they're tied to COVID. Technology, people are using technology and communication services and healthcare because of the COVID. And they're the COVID winners. And the losers have been the banks, industrials, the cruise ships, the airlines, etc. More the value type names. They're beat up and they're cheaper. The value area is down between, say, 15 and 20% for year to date. And so they definitely have lagged and been hurt. And whenever you see some good news on the vaccination side, they pop. So that's what happened this week. There was good news from Moderna and J&J on the vaccine. And so that really helped the value side move forward.
Okay, that's good to know. On to my next question. So with Canada's massive spending deficit, we know of this week, and a mounting federal debt level, so many people are worried about how we can operate under such a big deficit. So what do you think would be the implications on the TSX, the Canadian equity market, and in particular, the Canadian dollar?
Well, if this went on indefinitely, it would definitely be an issue. But I think it looks like we're going to do a lot of spending until the end of the year. And it's kind of like a war, I would say, in some regards. We're going to have higher deficits and government debt's going to be built up. But our economy is really tied more to global growth, and as is the Canadian dollar. And we're seeing global growth starting to do well. In Europe, China's recovering. Europe is spending a lot of money like the US in terms of their government spending, and their bank is also easing as well. And if you look at the end of the day, if you look at commodities, copper in particular, Dr. Copper, which is a good sign of the economy, of global growth, it's been on a real run here. So I think in spite of the deficits, we're going to do well because of what's going on globally. And that's the biggest factor, both for the C dollar and for our economy.
Great. And so on to the credit side, it is generally expected there may be more credit losses, write-downs, or bankruptcies to come as the aftermath of the COVID crisis unfolds and a potential second wave to come in the fall. So how comfortable are we with Canadian corporate credit?
Well, our models just went positive, and the corporate spreads got blown out. They were pre-COVID, they were about 100 basis points over Canada's. They went to over 300. They're back down to about 140 over Canada's right now. So they have come back in. That's primarily the central bank bringing rates down, allowing a lot of companies to refinance themselves at lower rates. So our models are positive. It's not an issue right now. It may be an issue if we have some really bad news on the COVID side, but I think here again, longer term, into the end of the year, I think we'll have more and more good news on the vaccine side. So right now, we're long. In fact, we just increased corporate exposures over the past month.
Okay, great. And related to my previous questions, also a question from one of our dear clients. So our commercial mortgages fund has always been a rather attractive strategy for yield enhancement. However, with the COVID, many people are now working from home, and we have seen waning demand for office and retail spaces. So how safe are these investments now?
Well, number one, our mortgage fund is very conservative. The loan to value ratio is 50%. It's also very short-term mortgages, so there's high liquidity. It's rolling over, over 3 or 4 years. So far, the experience has been pretty good. There's been no defaults. About 10% of the portfolio has asked for some interest payment deferrals, and just deferrals. I think around 2% for interest payment deferrals and principal deferrals, but so far so good. They don't have a lot of exposure to offices. I think it's around 18%, something like that, and it's primarily in small office buildings in suburbs. The same thing on the retail side. About 20% of the fund is in retail. The fund's very diversified, of course, and there's no major mall exposure there. It's primarily grocery stores and pharmacies, which are very much needed right now. So it's got good exposure. Any new business right now is being written at around 5-year Canada yields plus around 300 basis points. So that's around 3.5%, maybe 3.30 in that range there. So, but so far, so good. And with all of the liquidity being added, things look pretty good here, I'd say, into the end of the year. Now, if this goes into next year, there may be more issues, but so far, so good. And the good news here is the real estate exposure on the commercial side is very limited and a better segment.
Okay, thank you so much, Wayne. I think that will give a lot of comfort for a lot of our clients. So I guess that will sum it up. And thank you, Wayne, for your insight. And thank you, everyone, for your time. So if you have any questions, please email us, and we'll see you next week. Bye-bye.